Hello, everyone. Welcome to Money Talks.
Hi there. Good morning, everyone.
Hello, welcome to Money Talk. All right, hello and welcome to Money Talks. I'm your host, Bill Barheit, founder and CEO of Abra, and your host for the next few minutes.
You know, you could harp on how much you don't like the US dollar to me, but MicroStrategy uses dollars. You know, we sell to all of our revenues are in dollars, all of our costs are in dollars. We use dollars, right? And so, you know, when will we stop using dollars to do business? Well, not this year, not next year. So a much more practical thing to focus on is how much working capital do you need in the local currency you do business? And then how much treasury capital do you have? So MicroStrategy had $550 million in capital. We put $50 million into USD. We put $500 million into BTC, and we waited a year. And today we have $5 billion in BTC, $50 million in USD. Okay, so what was constructive? What was constructive was for one person to convert $500 million from USD to BTC. That was easy. What is not constructive? For me to hold my breath and wait for 8 billion people on the planet to stop using dollars. Right? Like that, you know, changing that, telling all my customers to switch and telling all my employees to start taking, that's like a billion times harder than the obvious thing. And I think everybody on earth is the same way, right? Everyone's got a savings account and a checking account. So in your savings account, you should have an asset which will appreciate in value against currencies over time. And that's BTC. Okay, so take all your savings and convert into BTC. And your checking account is a currency that you need to pay for your room and your board and your medical care. And in China, that's not the euro, that's not the dollar, that's not BTC, that's CNY. In Europe, that's EUR, right? Whatever I need to pay my taxes and pay my medical care and pay my day-to-day bills is going to be the local currency. So they're not going away. And in the US, it's going to be USD. Now, in all the weak countries like Afghanistan, it's USD, right? And in Venezuela, you could probably pay bills and they prefer you to be paying USD rather than paying the Bolivar, right? And in Argentina, they'd rather get paid in USD. I can tell you that for sure, right? Yep. Not in a peso. So here's a small idea and here's a big idea. The small idea is I hold 1 month worth of working capital in the local currency, the strongest currency. Right? It's not like, do you hate on the dollar? The point is your choice is the dollar or the peso or the Bolivar. Or, what's the currency of Afghanistan right now? Is there?
It's in the dollar.
The point is, so instead of hating on the dollar, embrace the dollar. The dollar is the strongest of the currencies with which you can buy and sell things with liquidity. So I think that the idea is I take my working capital, I put it in the strongest currency I can find. That's probably the dollar. I take my savings and I put it in the strongest asset I can find, which is right now Bitcoin. And if you're really smart, you convert all your money into Bitcoin, and then you just borrow against the Bitcoin. So instead of having $500 million in Bitcoin and 50 million in cash, why don't you borrow 500 million? You have $1 billion in Bitcoin, 500 million in debt. And now you could fund all of your expenses just by borrowing against the asset forever. And that means that because the portion of your capital, which is working capital sitting in the currency, is not appreciating, it's depreciating, right? You've made that point, right? So if you're a really well-run company, you don't want to carry any working capital, zero working capital, right? You want negative working capital. So you can work out the math. If you have $1 million of capital and you expect Bitcoin to appreciate at 10% a year, as long as your expense ratio is less than 10% per year, you can borrow money forever.
Yep.
If your expense ratio is less than the expected appreciation of the asset you're holding on your treasury, then you can borrow money forever, never sell anything, and get richer while you wait, right?
So question, so the wealthy have been doing this with equities for decades, right? They go to their prime broker, they borrow against their equity, they live off of it, or they buy houses, they buy more stock.
They've been doing it with sports teams too, like the Jets or the Patriots. They've also been doing it with buildings, like the Rockefeller Center or any real estate or any land. So they've been doing it with any property forever. They just finance the property and live off of it.
So the question becomes, how do you think this could affect or would affect the average consumer potentially 20 years from now? Meaning, does that become the base asset that everyone holds and then ultimately borrows against to live off of? Or is
You
it?
remember when people put all their money in their house and their house appreciated, and then what you would do is you would take a home equity loan.
Equity, right.
I mean, this is the equivalent of a home equity loan, but let's come back to property. If I had $1 million in Florida and I bought a house, I would owe the state of Florida $20,000 a year in tax. Okay, so the maintenance cost to carry $1 million of property in Florida is $20,000 for the tax. Then I have to fix the house when it gets rained on. Then I have to replace the roof, right? Then I have to upgrade it. So you could imagine the maintenance cost on the house is like 5%, $50,000 a year. So if you took the same million and you bought Bitcoin with it, your $50,000 a year in maintenance went to zero.
Right.
Okay, where will you see that money come out? It'll come out the other end, Bill. You'll actually probably be getting a plus 5% appreciation, because this is higher form of digital. It's a higher form of property. If I took everything I liked about property, I made it digital, I dematerialized it, and I could get rid of the property tax load and also get rid of the maintenance load on, you know how much it costs to mow your lawn if you have a lot of grass? I live in Florida. I have 2 acres, 3 acres. I have a full-time person, and all he does is maintain the lawn, and he's not alone, multiple people, right? So if you're trying to store money for 100 years as property, you're defeated by the tax and the maintenance obligations. And so you can still do it, by the way. The property goes up in value by a factor of 10, and then you take out your home equity loan. So people have done it, but it would be so much more effective a technique if you did it on a no maintenance cost property, for a bunch of reasons. One is Bitcoin's going to appreciate faster. Bitcoin's going to get taxed less. Bitcoin has lower tax rate. Bitcoin doesn't get destroyed by a hurricane that hits Miami. There's no insurance cost, right, on Bitcoin. And my house in Miami isn't interesting to rich people in Beijing and Moscow and London and Paris.
And right? Somebody in the comments wrote no eminent domain issue either.
It doesn't get seized.
Right.
Yeah. So if you were starting out, you're like, I think I'm going to basically buy a big house, and then I can live off it. I can reverse mortgage it as I get older. Well, that was your best idea for 30 years, Bill. That was the American dream: own a house and your wealth is in the house. But Bitcoin is so much better idea. So the answer to your question, a long-winded way, is yeah, you should put your discretionary wealth into digital property. You can keep it the rest of your life. And if you're smart, you can live off of either the yield from it or the borrowing or the reverse mortgage against it. And you have every reason to think that property will appreciate in value. One more point I didn't make. People keep making, if you buy a house, if you buy a house in Florida, you're better off to buy the house on 3 acres than you are to buy the condo on the 37th floor of a condominium, because people can punch up more buildings with 100 floors in Miami, but it's hard to create 3 more acres in Miami. So if you are buying property, your property is not scarce, right? Tangible property in the real world is not scarce as much as you wish it was scarce. Apartments with views of Central Park still aren't scarce when they punch up another apartment building next to yours. but Bitcoin is 21 million blocks in cyberspace. So it's a lot better idea than buying a tangible land or buying a condo or buying a house. It's even better than buying a sports team, right? I mean, people might build some more franchises, or people might get into Twitch gaming online and stop going to football games. So if you're looking for scarce property that's fungible, that's digital, that's low maintenance, that's transferable, that can be developed, well, Bitcoin is that best property in the history of humanity. So everybody should have a property strategy. You should buy property. You should hold it forever. And ultimately, it's a lot better idea to borrow against it than it is to sell it, because when you sell it, you get a capital gains bill, which is going up. We know that's going up a lot, right? We're going to debate how much. When you generate yield on it, you still actually owe tax on the operating income from the yield. So yield is taxable, sales are taxable, borrowings are not taxable. So when I borrow money, if I borrow 5% of my asset value every year for the next 100 years, and if the asset goes up 10% a year for the next 100 years, I'm going to be obscenely rich. And my grandchildren's grandchildren will be obscenely rich, having never incurred a tax bill.
Yep.
I never could have said that with a straight face about any other investment idea in my life. But this is the first time where really it is quite reasonable to think that in the year 2140, when that last block is mined and the mining network goes to transaction fees, Bitcoin's going to be stronger than ever.
Yep.
And you're only going to regret having sold it. What happens in 500 years when Bitcoin is worth $28 million a coin or 280 million a coin? And you're reading in your family history that your great-great-great-great-great-great-great-great-grandparents sold some to buy a Lambo. You're going to be like, I could have been the richest person in my city. I want to kill them.
Right.
What makes us unique is that we didn't just start and say, here's a paper, we think this works. We were very science-minded. So we started from first principles back in 2015, and 2016, 2017 were the two big years for this, where we just went and got a bunch of labs at University of Wyoming and Edinburgh and Athens and Texas, and Tokyo Tech. And we hired all these scientists. We just wrote papers. We wrote 111 academic papers. Wow. We went through an enormous amount of peer review, the standards of the computer science world, through conferences. And then we started building a high assurance version of those papers using a kind of a military grade language. It's called Haskell.
Was that your intent to basically slowly peer review individual pieces of this and say, okay, we have the pieces, let's bring it together and basically make the point that, okay, this has been mathematically proven to be correct as we go? Was that by design, or did it just work out that way?
Because it was really hard in 2015 to know what's real and what's not real. Like, for example, we didn't know if proof of stake is possible or not.
Right.
So we said, let's go ahead and build out a scientific corpus. And we're either looking for what's called an impossibility result, where we prove it can't be done, or we show how it's going to be done. And then you're just asking about trade-off profiles.
So can I dig in on that for one second? Because we have a lot of people from the Bitcoin world here who are very skeptical on proof of stake. What do you say, having gone through this peer review process, what do you say to people who say, hey, proof of stake is basically the equivalent of centralized government money and has no place in a decentralized cryptocurrency? How do you respond to that?
Okay, so you're always doing the same three things, whether you're proof of work or proof of stake. You're deciding who's in charge. The person who's in charge has to do something, and then the network has to accept that thing. So the problem is that first step. That's where everybody gets caught up. That first step in proof of work is the mining process, and that's what consumes all the energy. With proof of stake, it's synthetic. So if you have 25% of the supply, on average, 25% of the time, you get the right to do something, and you can do it yourself or you can give it to somebody. That's the difference between a pure proof of stake and a delegated proof of stake system. So the question is, who should be in control? And this is one of those exogenous, endogenous questions. Exogenous is mining. Someone outside of the system is doing something to be in control of the system, advance the system, build the system. Okay. The endogenous is somebody within the system is actually doing that. And so the question is, which is better? And I think there's trade-offs to both. When you deal with an exogenous system, you have something that's connected to the physical world. You have something that's connected to things like electricity and miners. And those people aren't directly connected to the price of the asset. They're not connected to the protocols operations. They're just there to do something. Okay.
Yeah.
Now, the problem with that model is as the price of the asset goes up, competition goes up, and there's an economy of scale phenomena. So what ends up happening is you go from lots of miners, and I used to be one back in 2011, mine with GPUs and these things,
Yep.
to vertically integrated data centers that are cost hundreds of millions of dollars with subsidized power and private ASICs. So over time, you get smaller and smaller sets of participation of the people who are in charge. So the
Yep.
system gets more federated. The other problem is there's no incentive for power reduction. Why? Because any gains you get, you just build more miners because it's a
It's the
competitive
opposite.
environment. So
Yeah.
you end up consuming more electricity.
Right.
The other thing is, if you have two proof of work chains that are roughly the same price and the same mining power, you actually have a perverse financial incentive to destroy one of the chains,
Yeah.
short sell it, and then move your miners over to the other chain if they have the same algorithm. So there's
Yeah.
this winners take all mentality of proof of work where there can only be one for it to not be vulnerable to Goldfinger. Now, on the proof of
Yeah.
stake side, you have a plutocratic mechanism where those who have more say. So some people aren't quite comfortable with that, but that's how shareholder theory tends to work for all of our publicly traded companies. And there are all kinds of things you can do to mitigate that if desired. It's really just about the resource. So you can invent a proof of merit. You can have multiple resources, so multiple tokens in the system with different economics behind them. That doesn't necessarily invalidate the system. The other thing is if you hold the token, you tend to want to care about its price appreciation and its stability, or else you're destroying your own money. So whereas the other system, they're disconnected from that token and they're mercenary, the other system, they only work within that system, okay? The other thing is it's a virtual resource. So we saw recently with the China mining crackdown, it's very expensive, time consuming, in some cases impossible to move your physical resource from one country to another country. In proof of stake, it's a virtual resource, so you can redeploy it at a click of a mouse from one country to another country. So there are philosophical differences here. And what we did over the last 6 years and others like Algorand and so forth, is we kind of built up this big scientific corpus and saying, are there things that are unique to proof of work that can't be replicated in proof of stake, or are they equivalent? And what we've discovered over the last 6 years of scientific research is that they're equivalent in terms of utility. From everything from random number generation to timekeeping to the ability to bootstrap from Genesis, there's papers that are peer-reviewed, cited hundreds of, in some cases, thousands of times, and with real running protocols in market that are securing more than $100 billion of value that demonstrate that these capabilities are equivalent. So it's now a philosophical gap. Where, you know, who do you want to be in charge? An exogenous mercenary resource or an endogenous internal resource? And are you comfortable with those dynamics? And for grandma, it doesn't matter.
Okay.
Because she's a consumer of both. She cares about operational costs, user experience, and reliability in these types of things.
She doesn't, ultimately, she doesn't want to know it's there, right? She just wants to know that the application that's using it is working and she can trust it.
Right.
Right. So before we get on to that topic of smart contracts and what they're going to do for us, just one more question. I think we have some basics on staking. Explain how the yield model works in Cardano when you're staking. We get a lot of questions on this. Just the mechanics of it. What's actually happening?
Well, it's a pretty simple system. So there's timekeeping inside the system, and we break it down to epochs, and those are about 5 days. And basically, there's a situation where you have proportional elections. So if you have 25% of the supply on average, not guaranteed, but on average, depending on how the random numbers work, 25% of the time you have the right to do something. Now, you can either give that resource to someone else, and that's called delegation, or you can host a private pool and consume it yourself. So it just depends on the amount you have. Then if those people show up for when their allotted time comes and make the block, they get paid for it, because it's compensation for services. And then there's a yield curve and it decays over time. And we parameterized it around 5.5%, I think. And then every single epoch, it decays a little bit. And then it'll go on for about 140 years. And the emission will go from where we started at 31 billion coins to 45 billion by 2140. And it turns out that there's actually a pretty good way of running a system. So, it's a multi-layered system. There's the individual holder. There's the stake pools that they actually delegate to, and then there's performance metrics. And there's a lot of dynamics about trying to create an ideal amount of stake pools in the system. So one of the things that we tried to create is this K factor. We wrote a paper out of Oxford to kind of try to balance this, right? But the basic idea is the price of ADA goes up, K increases, and K is the amount of ideal stake pools in the system. So K right now is set to 500, but we actually have over 3,000. But the top 500 actually make the most profit. And then as the value goes up, K can increase. So actually the system gets more decentralized over time relative to the price. And it's the opposite with Bitcoin. So that's one great dynamic. The other part of it is that delegation doesn't require bonding. So that's a common thing we see with other cryptocurrencies that are in the proof of stake space. Because we did all the research, we figured out you don't need to lock your tokens in order to stake them. So you have your wallet, you just click a button, which pool you like, and eventually multi-delegation's coming next year. And then you just stake there, but you can access it anytime and send it to Binance or to Coinbase or pay somebody, and whatever's left over will get redelegated. Other systems actually require you to lock your tokens for some period of time because they're worried about forks and other problems, but our protocol doesn't suffer from that problem.
So hopefully that $38 trillion goes just as far when we're all 150 as it does when we're all 50.
Well, I think you don't want to retire if you've got the energy.
Right? I don't want to retire anyway, whether it's 60 or 160, right? I mean, what does it even mean to retire?
Yeah, listen, for the guys, it's mostly true for guys, but for the gals as well, you could take a look at it. But Google the correlation between retirement and death. It's very highly correlated.
Scary. I mean, but everybody has an anecdotal story about that. I know so-and-so retired, they were dead 3 years later, or I know so-and-so stopped working and they were dead 3 years later, or, and I think there's obviously a causation reason for that.
Yeah.
Sure. All right. So let's talk about other examples of exponential tech. So what's the latest with the X Prize? What are the moonshots that are, really getting your attention right now?
Yeah. So, there's a lot. And I think of X Prize as sort of the innovation engine that challenges entrepreneurs around the world to solve the world's biggest problems, because they can. I have more faith in entrepreneurs than governments in solving problems. So what are we tackling? Last April, I convinced Elon to put up $100 million for a gigaton carbon removal prize.
Okay.
And, I asked him and he convinced himself. I don't want to take any credit away from him. It was like, his comment when we were texting back and forth was, let's do it. And that was great. And so we've got more teams.
I need a let's do it text from Elon. I don't have one of those. So.
I'll sell it as an NFT.
There you go. Exactly.
Maybe I should, and then no, never mind. Okay, so so we've got more teams registered for that gigaton carbon removal X Prize than any other competition we've ever had.
Yeah.
We have an X Prize going for feeding the next billion, which is funded out of Abu Dhabi and Tony Robbins. This is for cellular agriculture. Can you go from a stem cell to large scale production of fish and, in this case, chicken? We have X Prizes for Avatar X Prize. Can you build a robotic avatar where you can project your sensorium and feel like you're at a distance, and the person you're talking to there feels like you're there? I'm working on an age reversal X Prize right now.
Okay.
I've got about 80 out of the $125 million raised.
Wow.
And this is an X Prize that's going to challenge teams to reverse the age of a human by 25%. So it's 20 years.
How do you measure that? Do you have to wait like 40 years to get your prize? Or is it like some telomere effect thing, or what is it?
So I'm working with some of the top scientists on the planet, George Church and David Sinclair and a multitude of others on this. And we're going to be measuring it by a multitude of things. First of all, there are a bunch of aging clocks. Telomeres is a small part of the equation, but also what we call the omics, the proteomics, what genes are turned on, what genes are turned off. And we have to do it in 3 different organ systems, as well as tissue functionality, organ functionality, frailty of the individual. It's making it, unless you can actually and accurately measure it, you can't impact it. So that's an important part of the prize. But the science is now pointing at the idea that we can not only slow and stop aging, but potentially even reverse aging by impacting your epigenetics. And we can spend an entire show just talking about that, which we should.
No doubt. Yeah, we'll do another one. And so when you think about exponential tech in general, you've mentioned aging, right? And we should obviously segue into crypto at some point. But are there 2 or 3 other kind of fields of exponential tech that are the most exciting to you right now?
Yeah, let me rattle them off. So first of all, we're seeing massive increases in computation. And the whole realm of quantum computers are coming online. Something that was in theory, was in practice, and then the error rates were so high, they're not functional. We've seen one quantum computing company go public. A couple of others are about to go public. We're seeing some of the largest companies on the planet investing heavily in quantum computing. There's a there, right? And so we're going to see quantum computing impacting. The first area is like quantum chemistry. Like, can you predict what's going on at a molecular level in a way that can give you new material sciences, new, antibody antigen connections, new medicines? I think is going to be an important area. Then there's the whole world of sensors and networks. On the sensor side, we're going to be seeing embedded sensors every place, all the time, everywhere, measuring everything, heading into a world where, frankly, you can know anything you want. So it's going to become the questions you ask that's more important than what you know, right? When there are millions of drones imaging the world at centimeter, thousands of satellites at, sub-meter. And then on the network side, 5G is exploding on the planet's surface, about to give way to 6G, which is like 100 times faster than 5G. And then Starlink, right? Kudos to Elon and Gwen Shotwell at SpaceX. I mean, a couple of thousand satellites on their way to 40,000 satellites, and then you've got Bezos and Blue Origin and Verizon about to do that. So we're going to have layers and layers of satellites if orbital debris doesn't stop them all. 3D printing. One of my favorite companies is a company called Relativity Space that my venture fund Bold Capital is an investor in. And Relativity Space is 3D printing entire rockets.
Wow.
So it is a wow, right? So they built the Stargate printer, which can print, from the bottom up, 105-foot tall Terran 1 rocket, which is supposed to go up in Q1 of 22. And then they're building the Terran R, which is a fully reusable version like a Falcon 9. So, and this is about dematerializing, demonetizing, and democratizing the production of large scale, objects. So when you're not printing a rocket, you can 3D print a jet engine or an airplane wing. And then there's 3D printing for 3-story tall buildings, and there's 3D printing at a microscopic level, sort of Fantastic Voyage, like little robots that go into your bloodstream. From 3D printing into robotics, and robots have been a minefield of failed companies, but they're now converging because of machine learning capabilities. So a lot going on in robotics, AR and VR. Obviously, the whole Web 3.0 is exploding, and for me, sort of the convergence of AI, blockchain, and VR is going to change where we spend our time, the global economy of it all, reinventing. I'm clear that this decade we're going to reinvent every single industry on the planet. There's a massive disruption coming in healthcare and education, finance, insurance.
Is there anything, one of the things that I love about being around you is your energy, is your optimism. I remember even from earlier TEDs when you'd have debates about people who were pessimistic and you were always the optimist. And I always appreciate that, because I have this kind of sense that optimists in general are going to live longer, regardless of age-defying technologies, right?
Yes.
Yeah. Is there anything that you're pessimistic about right now? Or is there anything that really worries you?
The stuff that concerns me is Hillary Clinton's clip that you showed earlier. The notion that governments are, by their nature, stabilizing forces. that want to keep everything the way it is. And guess what?
That's nonsense. I mean,
there's
it's
no velocity switch on the rate of change.
Yeah.
And what's clear to me is that the speed of innovation isn't constant, it's accelerating.
Right.
There's more capital every year, more brains invested in innovation. The cost of compute or genome sequencing is dropping, faster than Moore's law in some cases. And so the amount of breakthroughs and transformation, so there's going to be this disruptive change as if AI takes over education, what are the teachers unions going to do? As one example, we're going to see the collapse of the healthcare system because the best healthcare on the planet is going to be driven by AI and sensors at 100th the cost. So a lot of change coming, and it's what's going to happen during that boundary effect of that disruptive change that concerns me.
Yeah, and how about crypto? Where does crypto fit in for you, and how do you think personally about it?
So crypto is a means for stabilization. For me, it's opposite of what we just heard from Hillary Clinton.
That's why I'm chuckling. Yeah, exactly.
It is the notion that it is, as the world is in turmoil, as people shift to a crypto-based, if you would, savings account, for lack of anything better, or stabilization. It's where we stabilize, because people revolt when they don't have food or don't have hope, and this is a means for both. I also am super excited about the whole realm of play to earn, where one of the things. Imagine if people can earn their living by helping, solve the world's biggest problems. One of the things I'm excited about is how do we create X Prize as a future DAO, right? Where if you're in the game, you're solving problems and you're making the world a better place and you're earning your living. I mean, those are the sorts of conversations that I'm excited about. I also think as we're living longer, the idea that having my wealth in a platform that I know is going to be around 100 years from now. So, I'm personally, I'm like 80% Bitcoin, 20% Ethereum, and looking at other protocols and so forth. But I'm shifting my capital out of USD because it's just the inflation rates. I mean, like, hello.
Yeah. Well, when you're 150.
McFly, it's like, it's kind of crazy. So
now, by the way, were you when we did the three-way seminar? You were a classmate of Michael Saylor's, right?
Yeah. So
at MIT,
listening, Bill and Mike Saylor and I had a hour and a half long webinar a few months ago. So Mike Saylor and I were both in the same fraternity, basically roommates, going through Aero Astro. And I've enjoyed watching Mike's arc of his career.
Yeah, he's amazing to listen to.
Yeah.
So lastly, before we wrap up, Abundance 360. So you've got an event coming up in the new year. Tell us about Abundance 360 and how do people get involved?
Thank you. So I, many years ago, started Singularity University with Ray Kurzweil, and it's been extraordinary. We have a lot of individuals, and I created the highest layer of Singularity, which is called Abundance 360. It's a year-round executive program. We meet for 3 days in LA every year. This year, it's February 2nd, 3rd, 4th. And then we meet 5 times through the year for a implementation webinar with me. And it's a look at 4 mindsets. I help people see an abundance mindset where we're going to be talking about how food, water, healthcare, education, all these things are becoming more abundant, transforming the world. An exponential mindset of helping people understand how exponential technologies are converging and changing every industry. A longevity mindset and a moonshot mindset. Bill, thank you for coming to speak at A360 this year.
I'm excited. It's going to be awesome. I'm excited for the rest of the conference, actually.
It's amazing. I spend the entire year curating these 3 days because my job is to change people's view of the world and what's possible. I remember
Yeah.
in 2013, I gave everybody Bitcoin because I said, this is coming.
Really?
I gave everybody Bitcoin. I had a Bitcoin ATM. I gave everybody like $100 of Bitcoin, which I had people like,
Wait, what year was that?
I think 2013.
Oh my God.
And, I had on my Twitter stream, I have an image of me doing that. And then everybody started emailing me later saying, I lost it. Where could you give it back to me? It was like, no.
I'm pretty sure that would be 50,000 at least today.
Oh, it was
At least.
anyway, it's crazy. But
Yeah.
here's the deal. Anybody's interested, you just go to a360.com or abundance360.com. It's a very curated group of entrepreneurs and CEOs, about 360 in the room, and then we have some 3,000 in our Abundance Digital on the live stream.
Yep.
But it's, the challenge is we are linear thinkers in an exponential world.
Right.
And I've committed to running A360 for 25 years. And my job every year is to like, this is now possible. This is what happened in the last year. This is where the next 2 years are going. And to help people see how powerful we are to take on the world's biggest problems.
Yep. I think it's fantastic.
A little bit, below Bitcoin are, Ethereum protocols like Uniswap. Uniswap, the code of it can't change. And can't change is almost as good as extremely hard to change. It might be better in a lot of ways. The core code of Uniswap is completely immutable. There can be new versions of it that, users might migrate to, but the version of Uniswap that anyone's using can't change like at all. And so the way it works today, it'll work tomorrow.
Yeah, because it's interesting that you went to the code change first, because I often think about this in terms of the on and off switch, right? And to me, that's probably more fundamental even than I'm thinking about it before I say it, but I'm going to go there anyway and say more fundamental than the ability to easily or not easily change the code. Meaning, if somebody put a gun to Rob's head and said, "Shut off Compound right now," to the public, could you do it?
No. But the reason why I talk about the code change is it doesn't matter if there's an on and off switch. If the code can change eventually, there could be an on or off switch. Right?
Okay.
So, all
right. So same gun is right here to your head. And sorry, I don't want to make, ruffle Rob. But now instead of saying shut it off, make the following changes right now. Could you do it?
No. So I'll describe how Compound's governance works for anyone who, hasn't gone deep into the mechanics of it yet. So Compound is, an extremely hardcore governance process. And the way it works is all changes to the protocol are voted on-chain. There's no off-chain components to it. And what the participants are voting on are modifications to the code base of Compound. It's not like a text-based proposal saying, hey, we hope that some foundation goes out and does this thing. The work has to be done up front, and you're basically voting on whether or not to implement new code. It's actually very similar to the way that Bitcoin might fork, whether it's a soft fork or a hard fork. You're voting on changes to the system.
Basically shows how traditional kind of institutional lending works and I think it's no different in what you grew up with in the prime space versus what you see at Abra, right? So talk about the prime model in general. Just give us like a quick overview of how that works.
Sure. I mean, anyone who's kind of been in the traditional space on the broker-dealer side or on the alternative side, hedge funds, kind of understands that obviously, prime brokerage and prime kind of works like a traditional bank. It's not really different other than, you're talking about large institutions, right? So deposits come in, collateral comes in, money goes out from a financing perspective. And that's kind of very basic, high level how, prime brokers and banks in general, make money. So crypto's no different. A lot of the ways that traditional prime brokers and traditional banks look to drive yield and look to make interest grow both for themselves and for clients exists on the digital and the crypto side. There's obviously a lot of nuances that go on within the crypto space just because of its emerging nature and it's still growing. But a lot of the kind of core pieces of that structure, exist for us as well.
Okay, so let's dive into for a moment some of the risks associated and how risk management in traditional lending works. And then I want to talk about DeFi, because basically, if you're holding assets in Abra Earn, you're earning via a combination of mostly traditional lending and then a small amount of DeFi, and they have different but somewhat related risks. So we talk about credit risk, we talk about market risk, we talk about liquidity risk. Why don't you highlight like one or two of the things that you think matter most, and maybe I'll fill in some blanks, but I would love to have everyone hear your perspective on that risk management and maybe even how Abra might be a little bit different.
Sure. Yeah. I mean, it's kind of like trying to pick your favorite kid. I think they're all important. But, I think in markets like we're experiencing right now, high volatility, rumor driven, I think liquidity is obviously a really key piece that you have to stay very, very focused on. And I think, another focus that we definitely have is counterparty risk, credit risk. Markets are going to be markets. We can't control what happens with BTC price, but what we can control is who we're facing, and the liquidity that we have, on our balance sheet. So, I think in these markets, you try and control what you can, because you can't control everything. And so I think for us, liquidity, credit risk, counterparty risk are very key. And then, obviously duration risk and concentration are always, things that you're managing regardless of market conditions. They obviously, become a lot more sensitive to them in high vol markets. But, those are things we look at as well every day, every minute in markets like this.
In Bitcoin, in Argentina, in Venezuela, in Turkey, in Russia, because their currencies are even more shitcoins than our shitcoin, right? The US dollar. And so when everybody says the dollar is so strong, I'm like, no, it's not. It's strong against, dictatorships, which we're approaching, but it's not strong against the renminbi. It's actually down against the renminbi the last 2 years. The DXY goes up because the euro, the yen, have you seen the yen lately? 130, 132. It's gotten crushed. So to say that the dollar is strong because the yen and the euro are super weak,
right?
It's oxymoronic.
That's like saying
That's a lot of stuff you didn't
one
ask.
cancer is strong because it's not stage 5 cancer. I mean, it just doesn't. Yeah,
it just doesn't make sense.
So when you put a shorter term lens on this, though, I get this. I mean, we agree clearly on the structural issues. Do you see this as kind of short, painful V, or do you think we're in for a prolonged, deep, like nuclear winter here?
No, look, it is the question, and
sure.
It's when you've been around a while. Although you don't look like you have, I look like I have. You look like you've been out surfing this morning, which I love. And I've
been up all night trying to figure out the answer to this question. So
yeah, well, no, but here's the thing: we are one or two policy errors away from depression.
Yeah. And
I don't use that term lightly. Everybody says, "Oh, Mark, you're so, such a downer." I'm like, no, I'm just a realist, right? Mm-hmm. An optimist thinks the winds will change. The pessimist thinks the winds will never stop. The realist just adjusts the sails. And I'm a realist. And we are two policy decisions away from a depression. In the 1930s, the government, the Federal Reserve and the Congress made two policy errors that turned a garden variety recession following the stock market crash into the Great Depression. One was they tried to tighten liquidity.
Right.
Okay. We just did that. So we've made one of the two. And the second were these idiots called Smoot and Hawley, who put up tariffs. Oh, wait, we did that too. So we might have already made the two policy decisions that will lead to depression. And the real thing that has me nervous is the long-term 90-year cycle. It's been going on for millennia. The 90-year cycle, 1840, there was a depression in the United States, 1930s, depression, 2020s. So it doesn't have to happen, But when you look at the problem with food production, food distribution, all these, accidental fires and explosions at food processing plants, you look at the price of wheat, what just happened with the whole Ukraine thing, and you look at, baby formula shortages. We are on the edge of some really ugly stuff. And look at Ross stores today, right? That's low-end retail.
Mm-hmm.
Okay. And that's not a value judgment. I mean, it's just lower priced. I don't mean lower priced retail.
Yeah.
Down 26%. Target the other day down 25%. Walmart. Here's the thing that most people don't understand about Walmart. Walmart makes 11% of their revenue every year in 12 hours. Okay. Every month at 12:01 midnight to 1 a.m, 12 times, they get 11% of their revenue because people go shopping the last day of the month, 10, 11 o'clock, fill up their carts. At 12:01 midnight, their EBT card, their food stamp card replenishes, and they buy. And if they don't have enough for the rest of the month, that's it.
That's it. Yeah.
Those people are living not even paycheck to paycheck. They're living moment to moment. And the fact that gasoline is doubled, maybe even tripled in some places, depending on where you are.
Yep.
Food prices are going up. This is really bad. And when you throw on top of it this China nonsense, which I will argue is intentional. I believe it's absolutely intentional to cause this type of pain, because what pain does is it causes people to look around and look for heroes.
Mm-hmm.
And what did Russia do when we put sanctions on them? They turned to China. Now they have this big long-term oil and gas, which is priced not in dollars, which has been the U.S. hegemony for, since the 1940s. They're pricing in renminbi and ruble. And the more times people look and say, oh, China's our hero. Look what they did in Greece. They went in and bought up all the ports and all this, major shipping route stuff. Look what they've done all over Africa, where they lent them money when they couldn't pay it back. They're like, well, we'll just take that port, or we'll take that, rare earth mineral, or we'll take that oil and gas reserve. So they are very strategic. They think very long-term. And I will argue that their plan is to be the superpower by 2050. Not tomorrow, not next year, but by 2050. And so if we continue to make bad decisions at the policy level, like taking liquidity out of a faltering economy, we're going to shoot ourselves in the head.
So it appears that inflation is going to come down, or is peaked, because the bond markets and oil markets did what the Fed wouldn't do earlier. Okay, and it probably would happen anyway, based on what you're saying. And so if the Fed basically says in the next meeting, okay, here's a 25-point hike, and we're going to do nothing after that except wait and see, which is kind of their way of saying, okay, we're probably in a recession and we don't want to tell you.
Yep.
Do you think it becomes a V and we recover quickly because the markets realize that, okay, they kind of get it? Or do you think it's still, because of all the piled on mistakes, another X years of or X months of pain?
See, I think, again, that's the really right question to ask. And I think economically, very little chance of a V, right? Mm-hmm. I think economically, there's so much damage that's been done by the tariffs from a couple of years ago. Stupid. I mean, just terrible idea. Mm-hmm. From the supply chain deglobalization movement, just dumb, right? Mm-hmm. If you go to just-in-time inventory, you can't suddenly decide, I don't want to buy from you anymore.
Right.
Take computer chips, right? Silicon wafers turned into chips. There's only 4 places in the whole world that produce wafers. We don't have any of that production in the United States. It would take 15 years, I don't know exactly how long, to get a really high-functioning fab here in the US. So to piss off those people that supply those really critical things in a digital world, so I think very little chance we have a V economic growth. Is it possible that animal spirits in the market could come back, and that so many people get short here in the short term, which is definitely happening. Look, every day the market goes down. And you made a really interesting point in the opening that most people don't realize. The biggest up days in markets do not happen in bull markets. Right. Bull markets go up a little bit every day and go down sharply on bad news or perceived bad news. So the biggest down days don't happen in bear markets, they happen in bull markets. And conversely, a bear market is a market that goes down most days, but then spikes sharply on good news or perceived good news. Like, oh, things weren't as bad as we thought. They're still bad, but they weren't as bad as we thought. So clearly, if the Fed does the Powell pivot, which I fully expect, for a short period of time, the market would definitely do a V. We might see a 10, 15% type of move. Crypto might follow. The problem for crypto right now relative to markets is everybody says, oh, it's trading like a speculative asset. Yes, because the free float of crypto, particularly Bitcoin, is so small.
So small, right?
65% of Bitcoins haven't traded in the past 12 months.
Right.
They haven't moved. And the hodlers don't care about short-term price.
Other
They
than
care about long-term value preservation.
The dips are great because they just add to their stash, right? So
Yeah. And so the problem is the short-term holders, the people who bought only because the price was rising. And I'm going to back up, 18 months. Again, huge policy error. So you make the dumb decision to lock down, right? Respiratory virus, we're going to lock everything down and stall the world. Dumb. Okay, fine. But you did that. But then you made a compounding of the error by giving people free money.
Mhm.
Right? You literally sent people free money. So you lock them in their apartment. You say you can't gamble. You can't go to Vegas. There's no sports. But here's some money for free. So what did they do? They started gambling in the markets. Meme stocks, crypto. Oh, and then what happens? Oh, well, we'll loan you some more money on top of that money so you can lever up and gamble more. And look, there's 4 types of participants in markets. There's investors. Investors are good, right? You try to buy what's cheap, you hold it for a long time, you sell it when it gets expensive, you keep investing. That's good for market. Traders, I have no problem with traders. They try to scalp a little on the ups, scalp a little on the downs. Professional, fine. Then there's speculators. Speculators buy things because the price is going up. They don't have any knowledge. They don't have any interest. They just, hey, it's going up. We'll buy it. But then there's gamblers. And gamblers are the worst because they're using other people's money, borrowed money, or free money. They don't care if they lose it because it doesn't have any meaning to them. They didn't earn the money. And here's the worst thing that can happen. If you make that first gamble and you win, it's like going to Vegas and you hit your first, hand in blackjack. You're like, oh, I'm good at this. No, that's luck. If you play long enough, you'll give all that money back and more because the house wins. That's how it works. And it doesn't mean you can't win, but you got to stop when you're ahead because if you just keep playing, you will lose. And so I think the same thing here is, I think many of the degenerate gamblers have been flushed out. I think that was the first leg down, the super levered. I tell this story and I won't name names, but someone close to me called me and said, they stole my Bitcoin. Like, what are you talking about? He says, well, I went to Bitfinex and said, just stop. So you went and you put 100-to-1 leverage on an 80 vol asset and the price went down and you didn't make the margin call and they seized the collateral. No, they stole my Bitcoin. I'm like, no, you lost your Bitcoin because you're an idiot. All right. And doing that is not theft. Now, someone said, well, but those firms, they entice people in promises of riches, get them to over-lever, and they are trying to steal. I'm like, oh, didn't think about that. So maybe that's true, maybe it's not. But no one stole the Bitcoin per se. They didn't go in and hack it and steal it. You shouldn't have had the leverage. But we have leverage in stocks. We have leverage in bonds. We have leverage in crypto. Now, a lot of that leverage has come out, but it's still higher than it was in 2008, believe it or not.
Wow. Really?
Crazy. It's crazy. And so when people say, are we done? Should we buy the dip? I'm like, no, you should sell the rip. Anytime things rip here, sell into it, get more cash, get more liquidity, and be patient because It's a long-winded way of saying, I think the economy does an L, ultimately a U, because we will survive, right? We will thrive in the future. The future is bright. And everybody says, oh, you're such a, you're so negative. I'm like, well, I'm not negative. Again, I'm just a realist. In the short run, it's going to be really tough. In the long run, I'm the most excited I have ever been in my life.
So I'm going to make it easy for people. Everything is about supply and demand, right? The more supply there is, the cheaper it is. The more demand there is, if supply is stable, the more expensive it gets, which is why we've had the problem with prices, because there wasn't supply of oil, but there was demand as everybody came out of pandemic. So what have we got going on in ETH? We've got a gigantic supply shock. So what is the supply shock? The small supply shock is right now, every day, miners are selling ETH. They probably sell 80% of everything they receive because they need to pay for their cash flows and their electricity and all of this stuff. So they stop. That's about 1 or 2 billion a month. Okay, that's nice. But then after that, we've also got the fact that staking is coming.
Mm-hmm.
Currently, there's about 9% of all ETH staked. Now, estimates are it should go up to around 30%. What does that mean? It means 30% of the ETH comes off exchanges, comes out of DeFi, comes out of CeFi, and is untouchable.
Yep.
Right? You're removing a gigantic amount of supply from the market, and it's locked for a year. So you can't do anything about it. Yes, you can trade using staked ETH and stuff like that, but it's not the same thing. So you've got this. So you're taking that out of the market. So you've got a huge supply shock. On the other side, you've got a massive demand shock, which is firstly, a lot of institutions wrongly didn't like Bitcoin because of ESG concerns. Proof of stake gets rid of that. Additionally, it now has a yield. So that's something that institutions love, is a yield. So now you need to make one asset allocation decision, which is, I believe in this Web3 technology world. So where do you allocate? Bitcoin or ETH? It's going to be ETH. Why? Because you're going to get something between a 6 and a 10% yield.
That's right.
So that's extraordinary. And you've got this deflationary issue of burning the tokens based on network activity. So that's another massive supply shock. So there's less ETH around every year. It's getting locked up. And you've got no miners. Put against this massive demand shock, and we've got the macro cycle turning. I look at this and think, holy shit, this is a massively imbalanced supply and demand situation.
Yeah. I mean, we shouldn't underestimate the complexity of what's happening right now. I mean, it's like, as a techie, I can tell you, it's like, the best example I could give you would be like changing the engines for an airplane mid-flight without landing. And
with a new technology. With a new technology.
Right. With a new, relatively unproven technology underpinning the engines that you're replacing the old engines with. And so it's pretty clear to say that, well, they've admitted it 100 times now, that they've all underestimated, the entire developer community underestimated the complexity of this. And this is just one upgrade of a few to come, because we haven't gotten into sharding and other things that actually provide massive scalability to the network. But it appears to be working, and they've done it right, which is part of why I'm so incredibly bullish on Ethereum right now. And this is something that we've talked about here on Money Talks many times. Do you view, well, it sounds like you view Bitcoin very differently, and you've alluded to why. Do you hold Bitcoin still?
Barely, which I know everybody hates, right? Barely. Not because I don't like Bitcoin or don't think it goes up. I just think it goes up less.